Welcome to This Explainer. Today, we're unpacking the absolutely fascinating take-private transaction of global real estate giant Kennedy Wilson by Fairfax Financial. We're going to literally reverse engineer this deal using the company's own financial filings, press releases, and market data. We want to see exactly how a multi-billion-dollar real estate empire shifts from public trading right into private hands.
All right, let's just dive straight into this massive number, $36 billion. That represents Kennedy Wilson's total assets under management right before this monumental deal officially closed. We're talking about a massive global footprint here, spanning across the US, the UK, and Ireland. When a portfolio of this sheer magnitude changes its fundamental ownership structure, it sends ripples through the entire commercial real estate sector.
So, here is our roadmap for today. First, we'll look at the Fairfax acquisition itself. Second, Kennedy Wilson by the numbers. Third, the strategic bond buyback. And finally, the post-merger future.
Section 1. The Fairfax acquisition. So the transaction finalized at a cash payout of $10.90 per share for shareholders outside the new ownership group. When the consortium, led by Fairfax Financial and Kennedy Wilson's top executives, finalized this, it represented an all-cash premium that really maximized immediate shareholder value, and it officially ended Kennedy Wilson's run as a publicly traded entity on the New York Stock Exchange.
Now, what is truly fascinating here is the unique structure of this buyout. It wasn't a hostile takeover or a complete clean-out of the boardroom. Instead, they engineered a structure that ensures business continuity while shifting financial ownership. Basically, Fairfax stepped in to hold the majority of the economic interest, providing that massive capital backing, while the Kennedy Wilson Management Group maintains full operational control over the day-to-day real estate decisions.
And this brilliantly illustrates that point. Straight from the Fairfax press release, they made it incredibly clear that the seasoned team under Chairman and CEO William McMorrow will continue steering the ship. This is absolutely crucial because in real estate, local market knowledge and long-standing relationships are literally everything. Fairfax bought the asset base, but they very smartly retained the exact architects who built it.
Moving on to Section 2, Kennedy Wilson by the numbers. Just look at the sheer scale of this pivot. In Q1 2026, they flipped a $40.8 million loss from the previous year into a $13.7 million gain. And their adjusted EBITDA? It surged to $141.8 million, up from $98.2 million. Fairfax wasn't buying a distressed asset. They were buying a company with massive positive momentum that was clearly executing on its operational strategies. To be clear, a huge chunk of that overall EBITDA comes from their highly stable baseline EBITDA, which sat at $94.1 million for the quarter. This baseline is their bread and butter. It's supported by a very healthy $28 million in investment management fees and a massive $11.2 billion in fee-bearing capital. This is exactly the kind of predictable, recurring cash flow that makes a company so incredibly attractive to a private buyer. Breaking down their components of value, we can see exactly where that cash flow actually comes from. Their multifamily portfolio is undeniably the crown jewel. With over 41,000 units running at a 94% occupancy rate, it generates an estimated annual net operating income of nearly $275 million all by itself. While they do have exposure to European and US offices, as well as industrial assets, it's really that massive, highly occupied residential portfolio that serves as the sturdy backbone of the entire enterprise.
Section 3. The strategic bond buyback.
So, right before the deal closed, Kennedy Wilson launched a cash offer to buy back its 5% senior notes due in 2031. And the response was just incredible. They managed to repurchase a staggering 99.03% of the total issuance. That's roughly $594 million, leaving barely a trace of the original debt. In corporate finance, hitting a 99% participation rate on a buyback is a phenomenally rare feat. So how did they achieve such a high participation rate? Well, by offering a premium. They paid $1,010 per $1,000 of bonds plus accrued interest. Now, this wasn't just some random financial exercise. This strategy was directly linked to the February 2026 merger agreement. By clearing out this debt, they proactively optimized their capital structure. It gave Fairfax a much cleaner slate and demonstrated absolutely stellar capital management right before the transition. As a result of their broader debt strategies, Kennedy Wilson locked in a highly manageable weighted average effective interest rate of just 4.9% across their $7.4 billion share of debt. Think about that for a second. In a macroeconomic environment where borrowing costs have been a major headache for real estate firms, securing a sub 5% effective rate on billions in debt is a massive competitive advantage.
And this is absolutely vital. By keeping 89% of their debt either fixed or hedged with interest rate derivatives, they essentially built a fortress around their balance sheet. They totally insulated this huge real estate portfolio from volatile interest rate spikes. When you're operating $36 billion in assets, predictability in your debt servicing is just as important as the rent you collect. Finally, Section 4, the post-merger future.
Look at how this all builds. It was a perfectly orchestrated sequence of events. It started with the merger agreement in February. Then they proved their operational strength with Q1 results in May, while simultaneously pricing a massive $1.8 billion senior notes offering. Fast forward to mid-June, they successfully expired that bond buyback we just talked about, and literally the very next day, on June 16th, the Fairfax acquisition was officially completed. It is literally a masterclass in corporate execution. Impartially speaking, looking at how the market viewed this, the transaction perfectly mirrors expectations. Late last year, JP Morgan downgraded the stock to neutral with an $11 price target. The current reality? A 1090 cash buyout just before the stock was officially delisted. The market basically priced in the value of the firm's assets and debt load almost perfectly to where the final ink dried on the Fairfax deal. Ultimately, what you should take away from this is that Kennedy Wilson has transitioned from a public entity subjected to the whims of the New York Stock Exchange to a powerful private company. Moving off the public markets allows William McMorrow and his management team to focus entirely on long-term property developments, acquisitions, and asset management, without the relentless short-term pressure of quarterly public earnings calls.
Which leaves us with this really provocative thought. Insulated from public market volatility, holding a heavily hedged debt profile, and now backed by the massive financial resources of Fairfax, what aggressive new real estate moves will Kennedy Wilson make next? They've got the team, they've got the assets, and now they have the private runway to execute. Thank you so much for joining me on this explainer, and I'll see you next time as we continue to unpack the world's most fascinating data.